Welcome to RAIN, the Real Estate Investor Growth Network with your hostess, Jen Josie. Join like-minded real estate investors and accelerate your business towards greatness. You will hear step-by-step strategies for success, interviews with real estate rock stars, and we will dig deep into past projects where we bear it all, including the good, the bad, and some just plain ugly. So get excited. Here's the bestower of badassery herself, the real Jen Josie. Listener discretion is advised.
Hi, and welcome back. I'm Jen Josie, creator of RAIN, the Real Estate Investor Growth Network. Whoop, whoop. On today's episode, we have a guest that will be sharing their badassery. But before we begin, here's today's badassery bestowment, my little badass gift to you. Today's topic is one of my favorites, direct mail. In a competitive real estate market, finding good deals can be one of the biggest challenges for investors. One often overlooked yet highly effective strategy is direct mail marketing. Here are 5 reasons why using direct mail can help you find profitable leads and gain an edge in the real estate investment game. Number 1, targeted outreach. With direct mail, you can pinpoint specific groups of homeowners based on criteria like location, property condition, or financial distress. By focusing your efforts on motivated sellers, such as those facing foreclosure, probate properties, or absentee owners, you increase your chances of finding undervalued homes ready for a quick sale. Number 2, less competition. Many real estate investors rely on online platforms, which can result in fierce competition for deals. Direct mail, on the other hand, allows you to communicate directly with homeowners who may not have listed their properties publicly yet. This approach can give you access to off-market deals that other investors haven't found. Number 3, personalized communication. Unlike impersonal digital ads, direct mail feels more personal. A well-crafted letter or postcard builds trust by showing that you've taken the time to reach out specifically to the homeowner. Personalized messaging makes potential sellers more likely to respond, especially if they're feeling overwhelmed by their property situation. Number 4, builds long-term relationships. Not every homeowner will be ready to sell right away, but direct mail helps you stay top of mind when they are. Regularly sending helpful and non-intrusive messages builds relationships over time. When homeowners are ready to sell, they'll be more likely to reach out to you since you've already established a line of communication. Number 5, cost-effective and scalable. While direct mail requires some upfront investment, it can be a cost-effective marketing tool compared to digital ads or paid leads. You can start small and scale your campaign as you find success. With the right messaging and targeting, the return on investment from a well-run direct mail campaign can be substantial. So, direct mail is a strategic and often underutilized tool for finding off-market leads. By targeting specific homeowners, avoiding the competitive frenzy of online listings, and building personal relationships, direct mail can provide you with valuable opportunities for profitable flips or rentals. Integrating this approach to your lead generation strategy can help you stand out in a crowded market. Now, on to today's episode of the Real Estate Investor Growth Network podcast. We have with us Sean O'Dowd. Sean is the managing partner at Scholastic Capital. Scholastic Capital buys single-family homes in elite school districts and then rents them to tenants on long-term leases. For that reason, Scholastic is a good fit for conservative investors looking for monthly cash flow, equity appreciation, and depreciation tax benefits. I am looking forward to hearing all about this unique investment strategy. So welcome to the show, Sean O'Dowd.
Hey, thanks so much. I appreciate it. I'm looking forward to the conversation.
Absolutely. So you are in Chicago, one of my favorite places. Give us a little background how you got involved with real estate.
You know, real estate's been honestly kind of in the blood from the beginning. So I was born in Chicago, and then I moved 22 times between when I was born and when I went to college. So
Wow.
it was a lot of moving, but it was at least for me a key inspiration for real estate because finding a place to live was just this fun thing we were doing every 7, 8, 9 months. So that got me interested in real estate really from the beginning. I got my license at 18. I never really did the whole agent licensing course. I never actually practiced with it. Studied a little bit in college. And then as soon as I had the ability to do so, I started buying property.
Very nice. And I got to just say one thing about Chicago. Are you familiar with Franklin Park?
I am, yeah.
So my family owned the farmland that I guess he was an investor, Mr. Franklin, that he purchased. So from like the early 1800s. And some of my family members were actually buried there's like a new runway at O'Hare that was built probably, goodness, 15, 20 years ago. And my people were buried there. They had to move them. And I'm sure it's just the headstones, by the way. They had to move them to a different cemetery. So, yeah, I got my ties in Chicago. And plus, you have great pizza. All right. So I love this marketing or this strategy that you have for investors. And you really work on the investor side, bringing people in to invest in this very niche form of real estate here. But I want to talk about the properties first, if that's okay. So I'm a former school teacher, and I'm very familiar with having, the school districts and buying real estate in those areas or renting or whatever. And just so you can be in a really good school district. So my very first question is, do people actually live in these rentals or do they literally just use them to establish residency? I'm just curious.
No, it's a great question. It's a great question. Our tenants are actually living in the properties.
Okay.
They're renting them to get access to the school district, typically for high school. Most commonly, we see families moving in where their eldest child is 14 years old and they're getting ready to start high school.
Okay. So my next question is that you talk about elite school districts. Where are these? Are they in your area in Illinois? Are they across the country? How do you find these elite school districts?
It's a long process, and it took us about a year actually to zero in on the school districts that we do. So there are a lot of different steps in that process. The punchline, the end of all that is those school districts are across the upper Midwest. We're intentionally upper Midwest focused: Minnesota, Wisconsin, Illinois, Indiana, and Michigan. And they are kind of spread out throughout there. It's typically suburbs of major metro areas: Minneapolis, Milwaukee, Chicago, Indianapolis, and Detroit.
And these are like private schools? Do you have some public schools or?
So exclusively public schools. And
really?
Exclusively public schools. And the reason why is because the public school feeds, if you live in that school district, or whether you rent or own, you can get access and get into that public school because it's directly tied. If you are private school, theoretically, you could live anywhere. So we see less of a correlation between the home prices in that case compared to what we see with the public schools where, hey, you live in this school district, you get access to that school, your home prices and your rental prices go up as a result.
Interesting. And how do you find these tenants? Because you said, like 8th graders getting ready to start high school.
It's actually been not that difficult, for lack of a better way to describe it. So there's a lot of different criteria that we're looking for the exact places that we're buying. But one of the big ones is we're looking at owner occupancy rates. We want to see how many people within that actual town own the properties that they're living in. Nationally, that's 60, 65%. For us, we're looking for 80, 85, 90% plus owner occupancy rates. And when you see a town with, call it 90% owner occupancy rates, it basically means two things. One, there's no multifamily at all in that town, because multifamily, a 300-unit apartment complex that's all rentals is going to skew that owner occupancy rate number down. So there's no multifamily. And number two, there just aren't rental houses. The majority of the homes tend to be a little bit more expensive. People aren't typically traditionally buying them as rentals. So when you have this situation of a lot of people are trying to get into this school district, a lot of people want to live in this town, and there's no rentals available. When you put your home on the market, it's typically the only home available if you want to rent, maybe one of two homes available. So it's not hard for us to rent these homes because it's the only one available.
Nice. Gosh, that is super smart, Sean. And how do you find the actual properties if there's so much owner occupancy already? And I did my badassery bestowment talking about direct mail, but how do you find these properties?
Yes, to date, it's been exclusively MLS. We're going to doing actually some direct mail next year. We've got a strategy that we're excited to try about that, but exclusively MLS to date.
Super, super smart. Very good. All right. So I was going through your website, and one of the things is you do really long leases. And I get it because the kid's going to be in high school for 4 years, but you pride yourself on saying you find them for families for 3+ year leases. So explain that a little bit.
Yes. So we do long-term leases every chance we get. And it's actually tenant driven by exactly what you said. If the family's moving in and their eldest child's a freshman, they're like, hey, I'm going to be here for at least 4 years. Like, why not just sign a longer term lease, lock it in now? The reason why 3-year leases is the one that's most common for us is the average American family is 2 kids, 2 years apart. So from the time the first kid starts high school until the second kid graduates, it's a 6-year period. So for our tenants, like a 6-year lease is kind of long to sign, but they will sign a 3-year lease with the intention of doing another 3-year lease at the finish of the first one. So it matches up with that high school period for their family.
Oh my goodness. So smart. And I see that you do higher end homes. Is there a specific reason for that?
They are higher end homes, but it's typically because the area itself is relatively high end with a good school district. And going back to that owner occupancy number, because it's called 90+% owner occupied, when we're buying homes, we are typically buying it from somebody who lived in it themselves. It was their own house. They took care of it. It was their own equity. They were upgrading the home, protecting the home, keeping it in good shape. So when we buy a home, our average home is 3.1 beds, 2.2 baths, 1,760 square feet right now. Average purchase price $480,700. It's a pretty good house in really great shape, and that just kind of cycles forward where it's an attractive home to a really great tenant.
Very cool. And this leads me to the second part of our conversation here is how do you finance these properties?
Yep. So we're pretty unusual for a real estate fund. We don't get cute with our debt, for lack of a better way to describe it. We use conventional. It's commercial financing, but it's structured like conventional, where it's a 30-year fixed interest rate and a 30-year term debt. So we aren't doing the 10-year term debt that a lot of folks tend to do. I had coffee with the banker this morning, actually, who was trying to talk us into it. The way that we think about it is like our investors are looking at us for a safe, stable, conservative investment. Like, we're going to use safe, stable, conservative debt and not get more aggressive with it.
Amazing. And who is your ideal investor?
We've seen kind of a variety of different investors, from individuals all the way up to we're pretty deep in conversation with some pretty large institutions about a large capital check. That being said, like, our preferred investor by far is a individual or family that is looking to deploy money into real estate. Doesn't have the time to do it themselves, wants somebody to manage it for them. And typically, so that's one, or they're an active LP. They've got LP investments kind of across the board.
And LP, we are LP means?
LP means investor. So limited partner, LP, someone who's an active investor, they've got investments in, call it 5, 6, 7, 8 things, where they're like stable, more conservative investment across their portfolio alongside like a multifamily development or something along those lines.
So, for my listeners, I work with a lot of people who maybe come into a chunk of change. Maybe they received an inheritance. Maybe they did really well at the end of COVID and sold their property and made quite a bit of cash. And they are looking to park their money there. So someplace that's going to be, a cash flowing asset. So do you ever work with, say, like self-directed IRAs? What about 1031 exchanges? So what are some other opportunities for people who maybe didn't get an inheritance coming in?
Yeah, it's a great question. So we can take self-directed IRA money and self-directed 401k. Not every fund can, but we do have the legal setup to do so. The other element to it is it's very difficult to 1031 into a fund. Our accountants believe that we are a fund you actually can 1031 into. That is, to our knowledge, very, very unique. And there's a whole host of extra steps necessary to do that. But we do have a very positive read from our accountants on that, and we think it is possible from everything we've been told to do so.
There are people who want to avoid paying those taxes, and so, but they don't want to deal with having to buy their own rental property. So this would be a great opportunity for them to park their money. So, how long can they park their money with you to have it produce more money and bring those friends home to mama? So what's an average length of time that someone invests with you?
Yes. So our fund is what's called an open-ended fund, which means we technically last forever as a fund. When we bring capital in, we've got what's called a 5-year lockup, meaning once the money's in, it's in the fund for 5 years. And the reason why a lockup just exists in general is if for whatever reason somebody gives us the money and then we go out and buy a home with it, and then a day later they're like, hey, I want the money back. Well, we're going to have to fire sale that home at a loss to be able to give them the money back. It's not a good deal for anyone in that case. So we've got a 5-year lockup period, and really in practice, like, we're building a portfolio for sale. We're building a portfolio of awesome single family homes that a larger institution would be interested in buying from us down the line. So theoretically, someone could take the money out after 5 years, but if everything continues to go to plan, like the big return will come in 7, 8, 9, 10, 11, 12 years once we build a big enough portfolio that someone would want to pay a premium for.
Wonderful. And how do the payouts work?
So it goes back to the multi-year lease element. We're kind of unique. We do monthly distributions rather than quarterly.
Sweet.
Most funds do quarterly, but because we've got these multi-year leases, we've just got a little bit more security in our forecasting than most funds do. So we pay out monthly distributions. We're paying one out tomorrow, actually. And it's nice. Everyone connects their bank account. We use AppFolio for our investment manager. Our fund admin accounting firm does the math for who gets what, and then we send out distributions monthly. We've got the depreciation as well. So that's everyone needs to talk with their individual accountant, but for most investors, our depreciations should be tax-free because we're sending out a significant amount of depreciation back out to the investors as well.
Excellent disclosure in there. Talk to your personal accountant.
So my co-GP is an attorney, so we are always buttoned up on the legal side.
And GP means?
Great question. General partner, meaning we are the general partner are the folks who are deploying the capital, and the limited partners, the LPs, are the ones who are investing the capital.
And what is the minimum investment for your investors? Do they have to be accredited, or anyway? I'll let you explain that.
Yes. So there's a whole bunch of rules associated with that. To your point, we have to take money only from accredited investors. We can't work with non-accredited investors. Or what's called a 506c fund, which means we can talk about it publicly, like we're doing here. But that means we also have to do an accreditation check for all of our investors. Minimum wise, our minimum is at $250,000.
Oh wow. Okay. And what does it mean to be accredited? I always forget these numbers.
Yes. So an accreditation check, it's a bunch of rules set by the government that basically says like you have to be at these thresholds to do these private investments. If I remember correctly, it's a minimum of $1 million net worth, excluding your primary residence. You need to be making either $200,000 or $250,000, or you need to have passed one or two of the series exams that show that you're a licensed financial professional. I think you need one out of those three. We actually can't do the accreditation or checks ourselves because theoretically our incentive is to have everybody be accredited. It's actually done by a third-party law firm. So actually, I'm not totally familiar with all the exact numbers on that.
I hear it multiple times, and I always forget. I just remember the million. So
yes, that's the easy one. It's a big round number there.
Exactly. And how would one get accredited? I know you said a third party, but just any random listener out there saying, oh, I have $1 million in assets, not including my personal home. Where would they go to get accredited?
So if you're looking at a private fund investment, most private funds will have a contract in place. We do with a bunch of services, which are really just law firms that specialize in this. So if you say, hey, I want to invest in Scholastic will say, great. We will introduce you to our third-party law firm, and then they can handle an accreditation check in about really 10, 15 minutes. It's a pretty easy process to do. The simplest way is to provide the first page of your last year's tax return, because that can verify the income threshold. If they need to do like a check to see if you passed a series exam or similar, it's slightly longer of a process, but every fund should have a law firm partner that does this, which means we also pay for it. It's actually not cheap to do an accreditation check for an investor.
So, very random question. When COVID hit and people were not necessarily going to school, did your business suffer at all? Because I speak to people all the time, and they are they spread their eggs out in a couple different baskets. But I have interviewed, say, short-term rental people who are hosts, and they put all their eggs in the short-term rental basket. And during COVID, they really, really suffered and were losing thousands and thousands of dollars. So did your business suffer at all during COVID when schools were shut down?
Not really. It's a function of the multi-year lease, really. Of like we've got pretty good stability of what's going to happen and what our next couple of years look like based off of that. The big variable that we can't really control for is maintenance and what happens to maintenance and when. We can forecast all we want, but like who knows on what that will happen. But as long as we've got that multi-year lease structure in place, we should be able to be pretty confident about at least what top line is going to look like over the next couple of years.
And you look very young to me. Maybe that's just from me being a former school teacher. You look like you'd be one of my former students. How did you start this fund as such a young man? And I mean, did you invest all that? Did you just find investors? Like, how did you start this from the ground up?
Yeah. The combination of a couple of different things. So one, my mom was a teacher growing up. So like, yes. So I got a lot of, and with her being a teacher and us moving so much, like it was easy growing up. Like I realized 10, 13, 14 years old, hey, everywhere we live, there's a really good school district and people are talking about that school district, want to get into that school district. So I recognized the idea a long time ago, from actually putting the fund together perspective. I went to business school, and a business school that has a big emphasis on private equity and private equity funds. So I got a lot of training specifically while at school. And then after school, I've been doing this strategy myself for a long time now. Meaning my wife and I were buying homes under this thesis, and we started getting inbound. And I was sharing pretty publicly of like what we were doing and why. And then we started getting inbound interest of like, hey, next time you buy one, like I'd love to kick some money in. They're like, hey, like can we buy a bunch together? And it just got to the point where it's like, hey, I believe in this thesis. I know how to put together a fund, how to run a fund. My partner graduated number 2 at Columbia Law School, specializing in fund creation. So it's like, okay, like we know how to do this. We've got the inbound interest. We feel really confident in what we're doing. We're already putting all of our own money into it. Like, let's turn this into a fund itself.
And I see you graduated with honors from the Wharton School of Business as well. So you are a pretty smart cookie yourself. So we have hit a lot of topics here, and this has been a really interesting interview. I think we hit most of these, but you do have one bullet point on here of what is your investment thesis? And I feel like we've hit most of the points, but is there anything you want to add to this specific investment thesis? You have experienced limited partners, high performance professionals looking for real estate. I love that one, actually. And then the long-term investors. Anything else you want to add?
Yeah. So I think the one other really big one is, and I think this is just kind of a macro point for real estate in general. For most of us, when we're buying real estate, like we are also going to eventually sell that real estate. And whether that's us, our kids, because we're going to hold it for forever, like whatever it might be, like someone is going to eventually be selling that real estate. And I think it's well worth the time to kind of reverse engineer what that sale is going to look like to improve the outcome on that sale. So for us, like we're building this portfolio to sell, like we're building it for Blackstone or Tricon or Invitation or Amherst to buy the portfolio. So our advisors, which is really our board, like we've got somebody from Blackstone, we've got somebody from Tricon to help us make sure we're buying the right homes that they're going to want to buy. And we've spent time with those institutions being like, hey, if we build a portfolio, where do you want the homes? That's why we're buying Upper Midwest. They told us, if you're going to sell us this portfolio in the 2030s, Upper Midwest is where we're going to want to buy it. When we're buying homes, we are screening for things that they want. Like they will not buy a home with solar panels. You could give them the home for $1. If it's got solar panels, they don't want it.
Why? That's a weird one.
It's there's a bunch of reasons. One of it is causes issues with insurance, shortens the life of the roof. A lot of the solar panels are on solar leases, which tend to be predatory. There's a bunch of issues there.
Interesting. And by the way, these are hedge funds, correct?
They're private equity funds focused on real single family homes. Yeah.
Gotcha. And so you are already thinking 20, 30 years down the line of how you're going to sell these. How many doors do you have currently? Do you know off the top of your head?
Yes, I do. We started buying with investor capital 4 or 5 months ago, and then in addition to the homes that I've been buying over the past 4 or 5 years. So we're at 21 homes right now. We're buying about 4 to 5 a month right now. Wow. And we're expecting that to jump up to closer to 10 to 20, probably early next year.
So cool. And my last question here on the first part of the podcast is an important one. How can people invest with you, Sean?
Well, if somebody wants to invest, just chat real estate, whatever it might be, we're at scholasticcapital.com. We are also pretty public. We send our investors our monthly update, and then we send almost exactly the same update, just minus the addresses of the homes, out to the public the week after. So if you want to sign up and get that, it's available on our website. I'm also pretty public on Twitter at SeanO'Dowd15. I'm the 15th Irish guy to create a Twitter apparently. I'm pretty public on Twitter as well about what we're doing, what we're seeing, what we're thinking about.
And you do talk fast, so I'm going to repeat that. It is scholasticcapital.com. And I got excited because I saw Scholastic, and I remember the Scholastic book fairs at public schools. You take your money, you're like, what am I going to buy? And it's such a big ordeal. So I love this very niche part of real estate and a way to invest, and super, super smart for you to jump on it. And I'm very, very impressed with you, Sean. And I want to move to the second part of hold on. Before I move to the second part of the podcast, you heard me give a badassery bestowment, which was a little nugget, a little bit of advice for the listeners. Do you have a badassery bestowment you'd like to share with the listeners? I'm putting you on the spot here.
Sure. I got 2 quick tips. You can have a pretty good sense of how an inspection report is going to turn out based off the photos of a house. There is a very strong correlation between whether or not there's a flag on the house outside, American flag, pride flag, like whatever flag, and the quality inspection report. If somebody's got enough pride in their house to put a flag, they take better care of the house. It's exceptionally well proven in the data.
I use garden flags, by the way. I renovated this house that we are in right now, and I put a gas lantern at the front, and it's a it's a historic neighborhood where I live. And I would tell people, they're like, "Which house is yours?" I'm like, "Oh, the one with the gas lantern." They're like, "No, I can't remember." And then they'd be like, "Oh, is it the Lionel Richie flag?" Because I had a garden flag that said "Hello" with Lionel Richie's face on it, and so I became the funny garden flag lady. But anyway, so I do have flags. I do take very good care of my house. That's a really good tip. And what is your second one?
The second one is you can also have a pretty good sense of what the inspection report's going to look like based off the kitchen photos. Every listing is going to have kitchen photos. What you want to look for is the oven or the range. If there is a hood over the range, or if there's a microwave air recirculator not over the range, in almost every place in the country, you have to have that to code. If there isn't one in the house, it means the work was done not to code by an unlicensed professional, which means there was probably corners cut elsewhere in the house as well.
Genius, Sean. Those are great nuggets. And I also look inside the oven. If it's spotless, I'm like, ooh, the lady who lived here, bravo to her. She took great care of this house. So those were some great badassery bestowments. Thank you for sharing that. We're going to move to the second part of the podcast, which is what makes Sean a badass. And I use the acronym BADASS, and the first letter is B for book. What is a book that's made a huge difference in your life?
Ooh, there's a lot of good ones. I really like But What If We're Wrong? It's about 15,
Say
20
that one more time.
But What If We're Wrong is the title. And the whole concept is it's trying to force the reader to think about what deeply held beliefs they have that might be wrong. For example, it says like, hey, if you lived 500 years ago, you would have bet your life on the fact that the earth was the center of the universe. And now today, everyone knows that's not actually true. And it says like there are probably things that we today believe to be true that will be proven wrong by science down the line. And it forces you to kind of think about like, hey, like what are we wrong about in our beliefs? What are we wrong about our investment thesis? For me personally, that like I should be challenging and trying to play devil's advocate with myself with how we make investment decisions.
I like it. I'm going to have to check that one out because I am never wrong, just FYI. Just check out my garden flags. All right. The first A in badass is for advice. You gave us some excellent advice, but what is the best piece of advice you've ever received?
That life is a marshmallow test.
What?
There's a famous experiment called marshmallow test with like 5 or 6 year olds where you give them a marshmallow and if you like wait 5 minutes I'll give you another marshmallow, and there's like cute videos of the 5 and 6 year olds like trying to like not eat the marshmallow. I believe that principle really remains true. And like, if you actually truly have long-term thinking, if you're thinking from a decade, 2 decade, 3 decade perspective, it's a pretty significant competitive advantage. And it's the best advice I've ever gotten.
I immediately went to like campfire marshmallow. I'm like, does he like it burnt or not on a s'more? Does he do a peanut butter cup instead of chocolate bar? Okay, I'm done. All right.
I'm a s'more guy.
Very nice. All right. The D in badass is for drive. What drives Sean to be successful? And I know you have 2 kids and there's one more on the way.
Yes. That's a big part of it. I'm down in my office right now and I've got drawings from the kids all over the place. And that's the kids are number one, and always will be.
Very, very good. All right. The second A in badass is for aspiration. I'm a big goal setter. So what is a goal you are currently working on?
Our big goal for the fund, we talk about it all the time, is we want to get up to 250 million NAV at a decade from now. NAV is net asset value. It's basically equity in the fund. So if we're all cash and we have $250 million worth of real estate, it's NAV is 250, or if we're say 25% leveraged, or 25% down payment, 75% LTV, 250 million NAV would be say $1 billion AUM. We care most about the NAV number. So 250 million NAV, 9.5 years from now is the big goal.
You are a very smart cookie because this just flies out of you so fast. I'm like, what? NAV, what? I can tell you are highly educated. And by the way, what did your mom teach?
My mom was a librarian. She has her master's in librarian science, so she was the library teacher.
Very nice. I love that. I am a advocate for libraries myself. All right, moving on. The first S in badass is for systems. I'm sure, as smart as you are, you have plenty of systems in place. So what systems do you have to help you achieve success?
We have a ton. I have our operations manager here at the fund. Her name's Mira. She's fantastic. Largely, her job is like building and maintaining our systems. So we use Asana kind of as our core for everything.
Smart.
And we have a scorecard, which is probably the most important, where everybody in the company has 3 metrics that they own. The scorecard is updated every single day. It's sent to our Slack channel, and we all have to be hitting our 3 metrics. They're green if we are, they're red if they're not. And that is really the basis of everything we do, is making sure that we're all hitting our metrics, and everything we do in Asana kind of feeds into that.
I love it. All right. This has been such a great interview. I'm going to wrap this up here with the final S in badass, and it's for success. What does success mean to Sean O'Dowd, number 13?
I love it. I had a professor back at school who said this, and it's always kind of stuck with me. And the way he described success was living up to your potential. Meaning, like, I do not have potential to be in the NBA, but like if I can hit 5 out of 10 jump shots, like that's probably living up to my potential, and like that's success on the basketball court. If my potential is to build a fund to 250 million NAV, and I do that, like it's living up to my potential. And that's always kind of stuck with me as a good way to think about success across a variety of different attributes.
And competing against yourself. I like it. And I saw that you were part of a crew team. Is that correct?
Yeah.
That's the boat thing, right?
That's right. Yep.
So, there was an old movie back in the 90s, and I'm going to totally botch this. They go to Oxford, and he was on the crew team, and she was the captain person. I can't even, do you know what movie I'm talking about? You weren't even born yet. I can tell you that. All right. So, all right. Thanks for aging me even more, Sean. This has been fabulous. So one more time, slowly, fast talker. How do people find you if they want to invest? They just received $500,000 and they are ready to invest and have those monthly checks, which are so nice. And that's not very common with funds. So one more time, how do they find you?
Yep. So we are scholasticcapital.com. That's kind of jumping point off number one. We are also pretty active on Twitter, which we actually meet more investors than you'd expect on Twitter. And I'm also, my email is sean@scholasticcapital.com. So I'm pretty available if anyone wants to reach out.
Wonderful. And you spell it correctly. It's SEAN, not the SHAWN. So Sean, it has been an absolute pleasure having you on the show today. What a bright young man you are. And this is just such a genius niche. And it was an honor to have you on the show today. Thank you so much for being here.
Thanks so much. It's been a lot of fun.
Absolutely. And that is all. Thank you for listening. We will catch you on the next episode. Now go out there and share your badassery. And don't forget, make it a great day. Take care. Bye-bye. Whoop, whoop.
Thank you for listening to RAIN, the Real Estate Investor Growth Network. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. If you need more badassery, you can follow Jen Josie by visiting therealjenjosie.com or become a member of RAIN by registering on rainmastermind.com.